to call this a bull-bear debate, but Victoria, you're just kind of like barely a bull, kind of a reluctant bull, a bull maybe for a few weeks. Why so reluctant?
I think you got to be ready to pull the ripcord on your bull thesis, as we get more data with earnings. But look, this market has legs. I know everybody hates it. Everybody does hate a bull market rally off of those October lows, but that uptrend's not invalidated. Yes, the macro looks horrible. There is no question the bond market's pricing in recession. Everybody's pricing in that we're going to hit a wall. But really, we are a little bit in no man's land. I think we could maybe leg up close to that 4,200 before we do hit that wall. I do think everybody needs to be prepared to be a little tactical right now. Data's coming fast and furious. I do think the Fed still goes 25 basis points in May, but then there will be a pause. I'm not sure we're going to get the cuts everybody wants, but I do think there will be that very well-desired pause here, John.
Well, 4,200 is not a lot of upside. Venu, you think that the earnings are going to be sobering. Why?
I think, the estimates are way too optimistic, John. So that is our principal concern. And I think as inflation moderates, our central thesis is that it's going to trigger negative operating leverage, which is nothing but saying that margins are going to be under pressure. We have seen margin pressure build from Q3 onto Q4. We just see that accelerating more. But meanwhile, if you look at bottom-up consensus numbers, incredibly, they are pricing in not only roughly a mid-single-digit growth in sales versus the trend before COVID, but also a 9% increase in earnings. In other words, margins expanding. We just don't think that's going to happen. In fact, as inflation comes down, companies are going to lose pricing power on the top line, but their cost base is going to be more sticky, as we've already seen, especially in the wage front, and that is going to cause margins to shrink. So I think that has to play out, and it hasn't happened as yet.
Yeah, Venu, we also haven't gotten a lot of pre-announcements, which you typically tend to see, ahead of the earnings season kicking off in earnest. I wonder whether you think that there's anything to be read from that, and if earnings need to come down versus what the expectations are right now, how does it speak to the mismatch in terms of fundamentals?
Yeah, so what I would say is that, you saw earnings coming down roughly 10% in the second half of last year. But then this year they have stalled, right? And then that's a wait and see. I think part of that is just the macro uncertainty. Analysts are in a wait and see. They haven't gotten guidance yet. But we are a lot more confident about earnings coming down. In fact, our earnings estimate for S&P this year is 200, which is quite meaningfully below where the bottom-up consensus right now is at 220. So I think it's just a matter of time before those earnings starts coming down, and the market has to price it. In fact, the market's behavior has been that the multiples have expanded very sharply. They went down to about 15.5 times in October of last year. But since then, earnings trend has been generally flat to down, but multiples have expanded 3.5 points. But I think so there's a mismatch, and there's a risk both on the multiples front and on earnings. And on the multiples, based on what we see today in terms of inflation, interest rates, and growth outlook, I think the fair value is closer to 15 times. So I think there's a lot of risk which is not adequately captured today.